All right, I'm here with part 2, assets. So assets is the money you have, the money you've saved in the bank, things that you have that are of value. Your home can be considered an asset. Sometimes a vehicle can be considered an asset. For lending purposes, we are looking, you don't have to necessarily disclose all of your assets to us, but we are looking to see that you have the funds to cover the down payment if you're purchasing and any closing costs. And then depending on the loan type, we also may be looking for reserve funds, mortgage reserves, and we'll talk a little bit more about those here in just a moment. The most common asset, the most common way people are saving their funds is a checking or savings account or money market account, just your regular bank account. And for that, we're collecting 2 months worth of bank statements to show that those funds are in there. We can also use a stock account or a retirement account as other acceptable assets for a purchase or a refinance are going to be things like gift funds. So if you have a family member, it has to be a family member. In most circumstances, it does have to be a family member. But if you have a family member that's willing to gift you money for your purchase, that is usable. Secured borrowed funds are also usable. So what we mean by secured borrowed funds is a loan that you have taken out that is secured by another asset. So if you own a property already and are taking out either a home equity line of credit or some sort of home equity loan and using those funds to then put down on a home, that's perfectly fine. Sometimes, it's pretty rare, but sometimes people have equity in a vehicle that they own free and clear, and you can technically take a loan out against that vehicle, provided the value's there, and get some funds that way. It's generally on the smaller side, but it is possible and it's happened before. And then the other really common way or common example of secured borrowed funds is going to be taking a loan out against your 401k. So an easy way to maybe access funds for a down payment could be to take a loan out against that 401k. Now, one thing I will caution you about is that not all 401ks and pensions allow you to take a loan out against them or withdraw funds early. And if you do, sometimes there are penalties. So you really want to make sure that you follow up before you decide that that's the route that you're taking. You want to follow up with your 401k or pension administrator to find out what you are able and not able to do when it comes to taking a loan out against a 401k. Now let's talk about unacceptable assets or unacceptable assets for a down payment. So examples of unacceptable assets, the first is going to be cash. Any large cash deposits are not going to be readily usable for a down payment. So if you deposit $100,000 into your bank account and we don't have any way to track where that money came from due to federal money laundering regulations, we aren't able to use that for the down payment on a home. We would generally, we're going back 2 months worth of statements. So we're generally going to have your most recent 2 months worth of statements that do not show that large deposit on there. Another example of unusable funds are unsecured borrowed funds. So an example of that is going to be something like a cash advance on a credit card or a personal loan. You are not able to use that. Okay, so I want to circle back to mortgage reserves. So these funds that we are looking for, these assets in your bank account, are going to be funds that you will use for down payment, closing costs, and in some cases, mortgage reserves. Mortgage reserves are liquid or easily accessible funds that are separate from the down payment and closing costs, and their purpose is to demonstrate to a lender that you as a borrower could continue to make payments in the event of an unexpected financial hardship. So basically saved mortgage payments in the bank. Depending on what type of loan you are trying to purchase or refinance is going to really dictate what those reserves are, how many are needed. Sometimes it's if you own multiple properties, so if you own a bunch of properties and that are financed, mortgage reserves are going to be required, depending on how much is owed on each of those properties. If you're purchasing a multifamily home, then the lender, again, is going to want to see that you have 6 months worth of payments saved that can be used towards that multifamily home. If you're getting a zero down program, some zero down programs require that there are a couple months worth of reserves saved. So mortgage reserves are another piece of the puzzle. One thing I really like for mortgage reserves are 401ks. So if you have a 401k and it's accessible and you don't plan on using it for your down payment, then it's fantastic for mortgage reserves because you don't actually have to take the money out. It can just sit there and, make you look good that you have this large asset that you could access if you needed to. All right. So that's my video on assets. Tune in tomorrow for credit.